Welcome. Accounting and Management Made Simple is your channel of choice where we break down complex and difficult accounting and management principles into simple, understandable concepts. Whether you are a student preparing yourself for exams or a professional looking to apply knowledge practically, this channel helps you to grasp and understand complex key topics with ease. Please subscribe, share, like, and comment. Thank you. Hello students. Welcome again. This is your tutor, Samuel Muchai, Accounting Made Simple. Today I want us to do December 2021 question 4, financial accounting question, CPA, December 2021 question 4. I want us to solve December 2021 question 4. Once again, as usual, I want to urge you to kindly subscribe, share, like, and hit the notification bell, so that every time we load this kind of videos, we are able to inform you. Further, please join us for our online classes. This is what we have done for the last 16 years, and I can assure you we are the best in this. So the question I want us to tackle today reads that Timothy and Lisa are in partnership sharing profit and losses equally in a manufacturing venture. Timothy manages the manufacturing entity while Lisa manages the selling and distribution end of the product. The following trial balance was extracted from their books of accounts by the end of the year, 30th September 2021. Sales 59 million, purchases of raw materials 28 million, production of wages 8 million, production supervisor salary, office staff salaries, distribution costs, factory insurance, provision for unrealized profit, carriage inwards of raw materials, cash at bank, 12% bank loan, interest. Like I've always said, every time you are reading the question, please learn to always ask yourself, where am I dropping this? Where am I supposed to drop this? Where am I supposed to drop this? So that even when we are now answering the question, you can very easily know when you are missing some things. You can very easily know when you are missing some things. Bank loan interest. I've always said, anytime you get a question, whether company accounts or any other company, any other firm, you must always look at the issue of the bank loan. Like this one, you told the bank, even if you're not told, if you look at this question, we've not been told about what was paid and what was not paid. So it's your responsibility to compute. In this case, we are told 12% bank loan, 12% bank loan, 6 million, 12% bank loan, 6 million, and we are told that the bank loan interest is 600. The bank loan interest is 600. So definitely, if you look at 12% of 6 million, it is not 600,000, and therefore some part of it was paid and part of it was not paid. What was the exact incurred is what we call as the expense in income statement. That is 12% of 6 million. What was incurred is what is the expense. But what was not paid is part of current liabilities. So then we have accounts receivables and accounts payable, manufacturing loyalties paid. Manufacturing loyalties. Anything manufacturing must always go to manufacturing. Anything manufacturing must always go to manufacturing. These are questions that combines manufacturing accounting and partnership accounting. Bad debts written off, office admin expenses, fuel and electricity inventories, opening inventories, capital account. The beauty with this one is not complicated. The capital account is from and the current account. Both of them have credit balances. Never forget that there are times that the current account may have debit balances. There are times current account may have debit balances, and therefore you need to be very sensitive whether it's a debit or a credit balance. You're given drawings, factory buildings at cost, plant and machinery, motor vehicle, allowance for depreciation for the non-current assets. Then you have the closing inventories, you have depreciation rates, you have the manufacturing. You're told that the manufactured goods are transferred to the warehouse at factory cost plus a 20% factory, 20% profit on factory cost. Partnership agreement provides each partner is entitled to a salary of 100,000 per month. You must mark that per month, meaning you multiply by 12 to get the annual salary. Timothy is entitled to 10% commission based on the factory profit, or Lisa is entitled to 10% commission based on the net profit. Interest on capital is to be charged at 10% per annum. Interest on drawings to be charged at 15% per annum. Fuel and electricity are to be apportioned at 80% of the factory and 20% to the office. Required manufacturing statement of profit and or loss for the year ended 30th September 2021. Statement of financial position is the 30th September 2021. So quickly we got to solving the question. So we start with our bank interest loan. Bank loan interest. Bank loan. So these are our workings. These are our workings. And we start with bank loan interest. We start with bank loan what? And we are told it is 12% of 6 million. 12% of 6 million should be 0.12, 0.12 of 6, 1, 2, 3. We get a figure of 720. Get a figure of 720. And we are told, below there, we are told, bank, one of the things that have been paid, and therefore we have a trial balance, is bank loan interest of 600. Now, this is the interest expense, this is the expense. This is the expense, so we less paid. We less what? This was incurred 720, but we are told we paid 600, meaning we have a liability of 100. This is interest payable. This is interest what? This is interest payable. That is interest payable. The interest expense is 720, payable is 120. Interest payable is 120. We are told that the depreciation rate, additional information number 2. The closing inventory gives you the closing inventory, so you don't need to deal with that. The only thing you need to be very, very, very careful. Like I've said over and over again, you don't have to follow the questions revision kits. You don't have to follow revision kits if the revision kit is wrong. Some of our students tend to think that the revision kits are 100% correct. No. I was looking at one today and they were giving us finished goods at 3.6. It cannot be, because the finished goods, closing stock of finished goods has unrealized profit. It has unrealized profit, and therefore you should not show it as 3.6. You're supposed to show it with net of the unrealized profit. You must always show the finished goods net of unrealized profit, and you're going to see how to go about it. So depreciation, so if we want to get the depreciation expense, and we are saying a building, it is 2.5%, 2.5 out of 100. Plant and machinery, it is 10%. Motor vehicles, and it's straightforward because we are told it is at cost. It is at cost. If you are told reduced balance, you must know its net book value at the beginning of the period. So building, if you got the building balance, factory building is 16,000, and that is almost 4,000. That is almost 4,000, 400. It's not 25%, it's 2.5. 2.5 of 16, 1, 2, 3 should be 400. That's true. We get a figure of 400. 10% of plant and machinery. Plant and machinery is 4,500. 4,500. Definitely 10% is 450. And 20% of motor vehicle, which is 2,400. 2,400, that is 480. That is 480. That is the depreciation. Those are the depreciation expenses. Now we are told then, number 3, manufactured goods are transferred to the warehouse at factory cost plus profit at 20% of the factory cost. I thought we're going to do it as we move on. The partnership agreement provides that each partner is entitled to a salary of 1,200. So partner salary partner salary is, we say they are Timothy and Lisa is 100,000 times 12, which is equal to 1,200,000, 100,000. We can actually say, we can use it in thousands. You can do it in thousands, 100 times 12, and therefore 1,200 partners' salaries. And that's part of appropriation. That is part of appropriation. Timothy is intended to a commission based on the profit, or Lisa is based on the factory profit, and the other one is on net profit. Interest on capital is 10%. Interest on capital. Interest on what? Interest on capital. So we go to the capital balances for both Timothy and Lisa. Timothy, capital, and Lisa. Timothy capital, it is 10,000, and the other one is 8,000. And we are told the rate of interest on capital is 10%. 10 out of 100. This is 1,000, and this one is 800. One of them is 1,000, the other one is 800. Interest on capital. Then you're told interest on drawings 15%. Interest on drawings. Interest on drawings. Interest on drawings. Interest on drawings, we are told it's 15%. So we get our drawings, Timothy and Lisa. Timothy, his drawings, it is 800. So we multiply by 15 out of 100. Lisa is 400. 400 times 15%. Let's get the balance. 0.15 of 800, 0.15 of 800, we get a figure of 120. 0.15 of 400, 0.15 of 400 is 60. Then we are told that fuel and electricity are to be apportioned at 80% and 20%. Fuel, 80% to the factory fuel, we are told it's 80%, and the office fuel is 20%. From the trial balance, our electricity and fuel, our fuel and electricity from the trial balance is 1,200. Is 1,200, 80% of 1,200. 1,200. We get the figures. 0.8 of 1,200. We get a figure of 960. 960 minus 1,200. We get a figure of 240. We get a figure of what? 240. And from there, we basically go to prepare our income statement. We basically go there to prepare our income statement. We go to prepare our income statement, and we are told we're supposed to prepare manufacturing and profit and loss account for Patrick and Lisa. Supposed to prepare manufacturing profit and loss account for Lisa, Timothy and Lisa. So we say Timothy and Lisa partnership. Timothy and Lisa partnership, manufacturing, profit and loss or loss account. Profit or, it's not a loss, but or loss account for the year ended year ended 30th September 2021. 30th September 2021. So we are starting with the manufacturing account. We start with the manufacturing account and we follow that we account for the raw materials the way we account for them when we are buying, or the way we are buying, account for inventory when we are buying our inventory. We know when we are buying our inventory, we start with opening stock, add purchases, less closing stock, cost of goods sold. Whether there is carriage inwards or there are returns, we capture them, all of them. So we say our opening inventory of raw materials, inventory of raw materials from the trial balance, shillings in thousands. Our opening inventory from trial balance of raw materials is 4,200. 4,200. We add purchases. Our purchases from the trial balance is of raw materials is 28,000. Our purchases from the trial balance is 28,000. Our purchases is 28,000. And we have something we are calling carriage inwards of raw materials, 600. Add the carriage inwards. Of raw materials of 600. We get a figure of 4,200 plus 2,800. 4,200 plus 28,000. 1, 2, 3 plus 600. We get a figure of 32,800. 32,800. That is cost of goods available, cost of raw materials available for manufacturing, cost of raw materials, right in full, available for manufacturing, not for sale this time, but for manufacturing. Don't be tempted to say for sale. It is for manufacturing. So we less closing stock of raw materials, less closing stock of raw materials. And we are told additional information number 1, the raw materials closing stock is 5,200. 5,200. That are 2,800 minus 5,200, we get a figure of 27,600. We get a figure of 27 what? So 27,600, and therefore you get cost of direct materials used. Cost of direct raw materials used. The cost of direct raw materials used. We add all the other direct costs, and the only direct cost we have there is manufacturing costs. Production wages of 8,000, because the supervisor salary is not part of the prime cost, is not a part of the direct cost, but the production wages of 8,000. Add production wages 8,000 to get total prime cost plus 8,000. 1, 2, 3, we get 35,600. 35,600 total prime cost. We get total prime cost. Now we add manufacturing overheads. We add manufacturing what? And we got to be careful how we handle manufacturing overheads. Manufacturing overheads, rate in full, manufacturing overheads. And we need to be very sensitive to ensure that we include every bit of manufacturing overheads. And the first one is production supervisor salary. Production supervisor salary. Production supervisor salary, we said the production supervisor salary is 240. 240. It's 240. We got down one to checking distribution cost, factory insurance. Is factory insurance amounting to 600. Factory insurance amounting to how much? 600. Then we have manufacturing royalties paid 800. Manufacturing loyalties 600. They were incurred in manufacturing. Then we have fuel and electricity. Fuel and electricity. We said there was a portioning. We said there was a portioning of fuel and electricity, and factory got 960. Factory got 960, so we bring 960 there. Now, inventory, capital account, current accounts. The very, very important things is the depreciation. Depreciation. We know our building is clearly labeled factory building. This is not just an ordinary building. The question says factory building at cost. And therefore, the depreciation of the building is a manufacturing cost. Factory building depreciation. So we say depreciation, factory building. The depreciation of the factory building, 400, it is a manufacturing cost. And plant and machinery. Plant and machinery. We always say that plant and machinery. Plant is the building in which manufacturing is taking place. Plant refers to the building where manufacturing is taking place, and machinery are the machinery we are using in manufacturing. The machinery we are using in manufacturing, and therefore their depreciation is a manufacturing cost. Their depreciation is a manufacturing cost. Plant and machinery is 450. Plant and machinery. Depreciation, plant and machinery, 450. 450. We check if there is anything else. But we also talked about interest, loan interest. Bank loan interest. But we know that bank loan interest is not manufacturing. It is an operating expense. It's an operating expense. So I'm looking if there's any other expense which we are missing, which is manufacturing expense, and I'm not getting any. So we quickly try to add them up. I'm asking myself whether I've missed any. I'm not seeing whether I'm missing any. 240 plus 600 plus 1,200 plus 960 plus 850. We get a figure of, let me repeat it again, 240 plus 1,200 factory insurance, let me check something there. Factory insurance. Factory insurance 600. Manufacturing loyalties. Manufacturing loyalties paid is 800. Manufacturing loyalties paid is 800. Manufacturing loyalties is 800 from the question. Let's add them up now. 240 plus 600, 240 plus 600 plus 800 plus 960 plus 850. 850, we get 3450. We get 3450. And that is total manufacturing overheads. Total manufacturing overheads. So we add the prime cost with manufacturing overheads plus 35,600. We get total cost incurred this period to be 39,050. 39,050. Those are the costs incurred in manufacturing in the course of the year. Those are the costs incurred in manufacturing, incurred last year, but we never finished. So we add opening work in progress. We add opening work in progress. And our opening work in progress among the inventories, the opening work in progress was 2,400. Opening work in progress is 2,400. So we add 2,400, we get a figure of 41,450. We get a figure of 41,450. We get a figure of 41,450. And although we were doing the manufacturing and we incurred all these costs, these ones were there at the beginning, and then we incurred this in the course of the year, we still have some goods we were manufacturing which were not finished as at the date of preparing the accounts. They were closing inventory of work in progress. And we are told additional information number number 1 tells us closing work in progress is 2 million. So we say less closing, it was not finished. It was work in progress. We were working on it. We never finished it. So it's not finished goods. It is not finished goods. So if you subtract 2 million minus 2, 1, 2, 3, you get a figure of 39,450. Get a figure of 39,450. Now that is manufacturing cost of finished goods. That is manufacturing cost of what?
Finished.
Of all the finished goods. Of all the finished goods. Of all the finished goods. Now once you get the manufacturing cost of all the finished goods, additional information number 3 tells us we are transferring the goods to the warehouse at cost plus cost. This cost we add 20%. So we get 20% times 20% times 2.2, it gives us 7890. 7890. Add factory profit. Factory profit, and we're saying our factory profit is 20% of 39,450, which we said it is 7890. It is 78 what? 7890. So the transfer price, we get the transfer price. We get the transfer price of adding the profit plus 39,450. We get a figure of 47,340. We get a figure of 47,340. Now this is the value of the finished goods. This is the value of the finished goods that we transferred from the factory to the selling department. This is the value of the finished goods that we transferred from the factory to the selling department. And we must realize that there is unrealized profit. Part of it is not realized because some of the finished goods were not sold at the end of the accounting period, and you cannot sell to yourself. The production department cannot sell to the selling department. It is not the profit we are adding here. The profit we are adding here is not realized until it lands in the hands of third parties, until we have sold the goods to third parties, and therefore the profit of the closing stock will be unrealized profit. The profit of the closing stock will be unrealized profit. This is all the value of all the stock we manufactured. Part of it we sold, and part of it was left with us. Part of it was sold, and part of it was closing stock. Whatever was closing stock, its portion of factory profit is not realized. It is not realized. It is not realized. It is not realized. So we go to the preparation of the income statement. So we prepare we continue just down there, and we say the income statement. We say the income what? We quickly go to our sales. It is shown there in the trial balance. Our sales are shown there in the trial balance. It's the first item actually. 59,220. 59,220. We say less cost of goods sold. There are no returns. Cost of goods sold. There are no returns. Cost of goods sold. There are no returns. So we say opening stock of finished goods. Please mark this. We are talking about the opening stock of finished goods. We do not sell the raw materials. We do not sell the raw materials. We do not sell the work in progress. We sell the finished goods. We sell the finished goods. So we go to the opening stock of finished goods, which is in the trial balance. It is 1,800. It's 1,800. 1,800. Then we add transfer price. the transfer price, the value of all the finished goods that we received from production. The value of all the finished goods we received from production, 47,340. 47,340. We add 1,800. We add 1,800 plus 47,340. We get a figure of 49,140. We get a figure of 49,140. That is the value of the closing of the finished goods available for sale. The cost of finished goods available for sale. Available for sale. Cost of the finished goods available for sale. Then we less closing stock. Please mark what we are saying. We are lessing the closing stock of finished goods, not the raw materials, not the work in progress, but the closing stock of finished goods. Additional information number 1. It is 3,600. It is 3,600. We subtract that, minus 3,600, minus 3,600. We get a figure of 45,540. We get a figure of 45,540. We get a figure of 540, and that gives us the cost of goods sold. It gives us the cost of goods sold. It gives us cost of goods sold. If we subtract from our sales minus 59,220, 59,220, we get a figure of 13,680. We get a figure of 13,680. We get a figure of that. Please mark this. Mark this. This is a profit attributable. This is a profit attributable to the selling department. To the selling department. Mark that. This is a profit attributable to the selling department. This is the profit that the selling department has made. But we also know that our manufacturing department was selling. Our manufacturing department was selling to the selling department, and they made their own profit of 78.90. The manufacturing department made their own profit of 78.90. The selling department made their own profit of 13,680, and these two departments, they are all part of the farm. They are all part of the farm. So we add manufacturing profit. You add manufacturing what? You add manufacturing profits. You add manufacturing profit, which is 47,340. 47,340. You add manufacturing profit, which is 47,340. Cost of goods, yes. 13,680 plus. Sorry. This is not manufacturing profit. The manufacturing profit we've said it is. This is the manufacturing profit, 78.90. This is the total cost of production. The total cost of production, but manufacturing profit, we said add factory profit, 78.70. Factory profit, 78 profit, so 78. So we add 78.90. We add 78.90. That is the manufacturing profit. 78.90 plus 13,680. We get a figure of 21,570. We get a figure of 21,570. We get a figure of 21,570. But we know that out of this manufacturing profit, part of the goods that we finished, were not sold, and therefore we have what we are calling closing stock and realized profit. 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 And therefore, we need to compute the closing stock and realized profit. We need to compute the closing stock and realized profit. We need to compute the closing stock and realized profit. Now, our we are told very clearly that our closing stock is given as 3,600,000. Our closing stock, additional information number one gives us finished goods. The value is 3,600,000. So we are told 100% is 3,600,000. 3,600,000. That is the value of our closing stock. The value of our closing stock is 3,600,000. But we are told that within these 3,600,000, there is some 20% unrealized profit. There is some 20% unrealized profit. So if 100% is 3.6 million, what is 20%? What is the 20%? And therefore we know what to do. We know what to do. We say 20% of this is equal to X. So 20%, we multiply this with this and this with this. We say 20% of 3,600,000 is equal to 100% of X. 100% of X. 100% of X. So we say X, which implies that X is equal to, because 100% of 100 over 100 is 1. 1X is equal to 20% of 3,600. X is equal to 20% of 3,600. And that gives us a figure of, is it 720.2 of 3,600 gives us a figure of 720. Gives us a figure of 700. The value of our unrealized profit is 720. 720. So I hope we are getting very well. We are saying the full manufacturing cost is 78.90, but 720 has not been earned. 720 has not been earned. So we less unrealized profit. We less unrealized profit. We less unrealized profit of 720. We less unrealized profit of 720. Minus 21,570 minus 720, we get a figure of 2850. Then we add opening. This is closing and here is profit. This is an opening unrealized profit. Some of the inventory we had at the beginning, of the year, they had unrealized profit, which was now sold to third parties and therefore was realized this year. Additional information number from the trial balance, we have a provision for unrealized profit of 360. So we add 360. Now this inventory, because now we sold it was there at the beginning of the year, now we sold it in the course of the year, so we earned that profit. Therefore we add it. 2850 plus 360, we get our figure of 21,210. We get a figure of 21,210. And that is now the total realized gross profit. That is total realized gross profit. That is the total realized gross profit. So we now less our expenses. We can now remove our workings here, hoping that you've gotten what I've done there. We now less our expenses. And as usual, we start with the workings. Learn to start always with the workings. So we have bank loan interest amounting to 720. Bank loan interest, we say it is 720. We get everything. Then we have depreciation for motor vehicle, 480. Depreciation, motor vehicle, 480. Some students will take the building in the manufacturing and still take it at operating cost. It is wrong. Here we are only taking for the motor vehicle because building and plant and machinery was in manufacturing. So we move down, factory fuel, office fuel 240, office fuel, office electricity and fuel 240, office electricity and fuel 240, and then we go to the trial balance. We go to the trial balance to check whether there are other expenses. And from the trial balance, we can see office staff salaries. Office staff salaries. Office staff salaries amounting to 3,600. Distribution cost 2340. Distribution cost 2340. Factory insurance, provision finance, profit carriage, raw materials, backup, manufacturing notice, bad debts written off 40. Bad debts written off, or bad debt expenses, call it bad debt expenses 40. Bad debt expenses 40. Then office admin expenses 880. Office admin expenses 880. I don't think I'm seeing anything else. This should be the expenses. So we add them up. We add our expenses up to see where we are getting to. 720 plus 480 plus 240 plus that is 600 plus 2340 plus 40 plus 880, we're getting 8,300. We're getting a figure of 8,300, and that is total expenses. Total expenses. Total what?
Expenses.
Total expenses. If we subtract our gross realized profit, 21,210, we get 12,910. We get 12,910. This is profit for the year. Profit for the what? You must remember the formula. You must remember the format. You must remember the format of a partnership. Always remember, have the format memorized. Because we know, once we get the profit for the year, we always ask ourselves, do we have interest on drawings? And our question gave us interest on drawings. Our question gave us interest on drawings about this. And we say that interest on drawings are incomes to the firm. Interest on drawings are income to the firm because we charge the partners, and that is an income. It is the firm that is earning the interest on drawings, and therefore we add interest on drawing. We add interest on drawing, so we say add interest on drawings. Add interest on drawings, and we are saying interest on drawings. Timothy 120, Lisa 60. Timothy 120, Lisa 60. Timothy 120, Lisa 60. You must know the double entry on interest on drawings. We are crediting the income statement. We are crediting the income statement when we add it as an income, and we are debiting the partners' accounts. We are debiting the partners' account. We are debiting the partners' account. By this time, we could actually prepare the current account. We could actually prepare the partner's current account so that you can see how they move. So that you can see how they move with this. So that you can see how they move with this. Once again, if you have not subscribed, please subscribe, like, share, hit the notification bell so that we can inform you when we make such videos. So if we were to get the partner's current account, we will say balance brought down. You say balance brought down. We say balance brought down. Balance brought down. And you're saying it is Patrick and Lisa. From the trial balance, our partner, from our trial balance, we get Timothy and Lisa. Our current account for Timothy is 400 and 600. 400 and 600 for Lisa. 400 for Timothy and 600 for Lisa. And therefore we are saying, as we credit, by adding to the income statement, we are creating the income statement, we come here and we debit partner's current account, Timothy and Lisa. And we say interest on what? Interest on drawings. Interest on drawings. And the figures 120 and 60. 120 and 60. 120 and 60. 120 and 60. Now from there, if you get 678, we add 180. We add 180 to get the total income to be distributed, to be appropriated. We get the total income to be appropriated. 12, 9, 10 plus 180. We get a total figure of 13,090. 13,090. That is the total profit to be appropriated. That is the total profit to be appropriated. 12,090. That is the total profit to be appropriated. And we know how to do the appropriation of the profit. We are given under the partnership deed. We are given under the partnership deed. We are given under the partnership deed. So that's the profit to appropriate. So we say less. Everything we've been told there to remove, we now start removing. We start removing it. We are told clearly, additional information number 4. Each partner is entitled to a salary of 100,000. So we say our balance is 13,090. Balance is 13,090 less partners' salaries. Partners' salaries. And our partners are Timothy and Lisa. Put Timothy and Lisa. Timothy gets 1,200. Lisa gets 1,200. They give us 2,400. We subtract from 13,090. 13,090 minus 13,090 minus 2,400, we get a figure of 10,690. We get a figure of 10,690. Then we are told that we have interest. We have interest on capital. We have less interest on capital. Less interest on capital. Less interest on capital. And we say that our interest on capital is Timothy and Lisa. Timothy gets 1,000 and Lisa 800. Timothy gets 1,000. Timothy gets 1,000 and Lisa gets 800. The total becomes 1,800. 1,800. So we subtract that minus 1,800. We get a figure of 8890. We get a figure of 8890. Get a figure of 8890. Get a figure of 8890. Then we are told additional information number 4. The second part we are told Timothy is entitled to 10% commission based on factory profit. Based on factory profit. And we say that our factory profit, was 78.90. 78.90. So we are paying commission, less commission, and we are saying Timothy gets 10%. Timothy gets 10% of 78.90. That was the factory profit, which is 789. And Lisa gets 10% based on the net profit. 10% based on the net profit. And we say our net profit, our profit for the year is 12,910. Our profit for the year was 12,910. Our profit for the year was 12,910. So Lisa gets 10% of that profit. 10% of 12,910. 12,910, which is 10% of 12 profit for the year. 12,910, yes. 1291. So Lisa gets 1291. We add the two. 1291 plus 789. We get a figure of 2080. Once we pay everything, once we distribute everything, if we subtract from 8890 minus 8890, we get a figure of 6810. Now, after we have appropriated everything the way we are supposed to do, we still have a balance. We still have a balance of 6810. And at the beginning of the question, we are told Timothy and Lisa are in partnership, sharing profit and losses equally. So we say profit share is equally. They are sharing profit and losses equally. So Timothy gets 50%. Of 6810, and Lisa gets 50% of 6810. 0.5 of 6810 is 3405. Is 3405. This gives us 6810, and therefore our balance is zero. Now the biggest responsibility now we have is to pass all this information from here all the way. We transfer this information to the partner's current account. I always tell students, don't struggle preparing partner's current account. Just look at the information of the profit after deducting the expenses, profit for the year, and every information that you will have here for the appropriation, you now take it to the partner's current account. You cannot prepare the partner's current account unless you are through with the appropriation. At least we recorded the interest on drawings. Then we come here, we say partner salaries, they have earned, so we increase their claim against the firm. So we add the salaries, that each of them gets 1,200. Then we have interest on capital, 1,800. Interest on capital, 1,800. Then we have commission. 789 and 1291. 789 and 1291. Then we have profit share, 3405. 3405. Something very, very important. Never forget that the interest on drawing is borne by drawings. Interest on drawings is borne by drawings. So never just capture interest on drawings and forget drawings. Don't forget drawings. So within our question from the trial balance, we are told that trial balance drawings for Timothy was 800 and Lisa was 400. So we say drawings for Timothy is 800. And Lisa, it is 400. So we close our account. To know the balance that we are now going to take to the balance sheet from the partner's current account. So this one is no longer important. Now we can erase it. And complete our partner's current account so that we can take the balance from the partner's current account to the balance sheet. So we add them up. We add the debits for Timothy, 400 plus 1200, 400 plus 1200 plus 1789 plus 3405. We get a figure of 6794. If you subtract 1200 plus 800 minus 1200 minus 800, we get a figure of 4794. Sorry, this is not 1200, this is 120 and this is 80. So 6794 minus 120, 6794 minus 120 minus 800, we get a figure of 5874. So our balance carried down is 5874. 5874. So 6794. This becomes 6794. In other words, this is what we earned: 400 plus 1200 plus 1000 plus 789 plus 34. You got 6794. And then we did drawings, and then we incurred interest on drawings. We did drawings and incurred interest on drawings, and our closing balance from the partner's current account for Timothy is 5,874. 5,874. We do the same for Lisa. We add, this is 1800 plus 800 plus 1291 plus 3405, we get a figure of 7296. We subtract the drawings and the interest on drawings, minus 60 minus 400, we get a figure of 26. Something is amiss there. It cannot be 26. It's too high. 7296 minus 460. The figure is 6836. 6836 for 7296. Now, this is a figure to take to the balance sheet. These are the figures we are going to take to the balance sheet. Some students will still carry this information here to the balance sheet. No, we only take to the balance sheet the balance carried down. And these are the balances carried down. So quickly, we prepare Timothy and Lisa statement of financial position. Very fast. Timothy and Lisa partnership. Statement of financial position. As at 30th of September 2021. The format is the same. 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 So we start with assets. We start with assets. We come to non-current assets. We come to non-current assets. And we know we prepare the balance sheet, the non-current assets based on the permanent. So we start with factory building. So we know that we have the cost in Kenya in shillings in thousands. We have provision for depreciation, shillings in thousands. We have net book value, shillings in what? In thousands. And we say factory building. The question gives you the cost. Factory building cost is 16,000. Plant and machinery is 4,500. Motor vehicle is 2,400. 2,400. And therefore, we now get the depreciation. The depreciation, we get the depreciation from the trial balance, and then we add the charge for the year. We get the depreciation from the trial balance, and then we get the charge for the year. We get the charge for the year. These are the depreciation charges for the year. These are the depreciation charges for the year. From the trial balance, the building is 1,200. The building is 1,200, but the charge is 400. So now the building gets to 1,600. It comes to 1,600. It comes to 1,600. So we are basically saying the balance at the beginning of the year is 1,200 plus the charge for the year of 400. We get 1,600. Get 16 what? 100. Then for plant and machinery, at the beginning it was 900. So 900 plus charge for the year for plant and machinery of 450. 450. We get a figure of 1,350. Get a figure of what?
1350.
1,350. And then for motor vehicles, at the beginning it was 720. 720. That was the beginning of the year in the trial balance. Plus the charge for the year of 480, 480, we get a figure of 1,200. We get a figure of 1,200, and then we subtract to get the net book value. We subtract the new figures to get the what? To get the next book value. 16,000 minus 1,600, 16,000, 1, 2, 3, minus 1,600, we get a figure of 14,400. You get a figure of 14,400. 4,500 minus 1,350. 4,500 minus 1,350. We get a figure of 3,150. Get a figure of 3,150. 2,400. 2,400 minus 1,200. We get a figure of 1,200. We get a figure of 1,200, and then we add them up to get the total non-current asset. Plus that 150 plus 14,400, we get a figure of 18,750. 18,750, and we say that is total non-current assets. Total non-current assets. Total non-current what? Assets. Then you say current assets. Current what? Current assets. Current assets. And we know that our assets starts with inventory, and we have three categories of inventories. We have three categories of inventories. Remember what we did? We talked about unrealized profit, and we said unrealized profit, yes. Closing unrealized profit of 720. So our closing inventory from the additional information number 1, raw materials is, we do not The raw materials and the work in progress are not loaded with unrealized profit. The only inventory that is loaded with unrealized profit is finished goods. So raw materials, an amount of 5,200. Work in progress, no unrealized profit, 2,000. Then finished goods. Finished what?
Goods.
Finished goods. We are saying that these finished goods of 3,600, they have closing unrealized profit. Opening unrealized profit, closing unrealized profit of 720. So you subtract 720. You subtract 720 at the 600 minus 720, we get a figure of 2880. 2880. 28 what? 2880. Then we go to accounts receivable. We go to accounts receivable from the trial balance, which is 1400. Our accounts receivable from the trial balance is 1400. Accounts receivable from the trial balance, it is 1400. And then we go to bank. Then we go to bank from the trial balance. Go to bank from the trial balance. Go to bank from the trial balance, and we are told bank, cash at bank is 7,200. 7,200. So we add everything up. We add everything up. 5,200 plus 2,000 plus 2880 plus 1,400 plus 7,200, we get a figure of 18,680. We get a figure of 18,680, and you're saying total current assets. Total current what?
Asset.
Total current assets, giving us total assets. Giving us total what? So we add the current assets and non-current assets to get total assets, 18,680 plus the total non-current assets of 18,750. 18,750, giving us a figure of 37,430. Giving us a figure of total assets of 37,430. 37,430. 37,430. 37 for what?
That.
37,430. Then we get the sources of funding. How did we fund our assets? How did we get the funds? So we say financed by, and we say we finance by capital and what? Capital and liability. We finance by capital and what?
Liability.
Liability. You finance by capital and liabilities. So we say financed by. So we say financed by capital and liabilities. Like financed by capital and liabilities. And we know our capital is from the trial balance. Our capital is from the trial balance for Timothy and who?
Lisa.
And Lisa. From the trial balance, our capital for Timothy and Lisa is 10,000 and 8,000. 10,000 and 8,000. You add the two, you get 18,000. Then we say the current account. You say the current what?
Account.
Current account. And again we say Timothy and who?
Lisa.
Lisa. Now we say the current account balances are these ones. These are the current account balances. So Timothy 58.74 and Lisa 68.36. 58.74 and 68.36. 58.74 and 68.36. 68.36. So we add the two. 58 74 plus 68, that is 6. We get a figure of 12,710. Get a figure of 12,710. And then we add 18,000 plus 18,000. 1, 2, 3. We get a figure of 3710. We get a figure of 3710. 3710. This is closing capital. Closing capital. Closing capital. Then we say non-current liabilities. Non-current liabilities. Once again, if you have not subscribed, please subscribe, like, share, comment, hit the notification bell so that when we do this kind of videos, we are able to inform you. So with additional information from the trial balance, we said we have a 12% bank loan worth 6,000. 12% bank loan amounting to 6,000 from the trial balance. Then we come to current liabilities. We come to current what? Liability. We come to current liabilities. And we say accounts payable, always. It's either bank overdraft, then accounts payable. We don't have a bank overdraft. Now we come to our accounts payable from the trial balance, and we say it is 600. And then we said we have interest payable amounting to 120. Interest payable amounting to 120. Giving us a figure of 720. Giving us a figure of 720. And therefore, if we add them, 720 plus 6123 plus 3710, 3710, we get a figure of 37,430. So we get a figure of 37,430. 720 plus non-current liabilities of 6,000 plus capital 3710, we get a figure of 37,420, which is equal to our assets. 37,430. 37,430, which is equal to our total assets. So we are saying total current liabilities. Total current liabilities. And then here we say capital and liabilities. Say capital and liabilities. And that's how our question balances. I want to repeat, please, if you have not subscribed, kindly subscribe, like and share, and hit the notification bell so that we can always inform you when we have this kind of videos being loaded in our channel. More to it, join our online classes. We've done this for the last 16 years. And we have CPA graduates from across the globe. Thank you very much. Welcome.